Thank you for joining us today for our market update. Just a refresher, there's a Q&A button at the bottom of your screen for questions, and keep in mind that these will be seen by other attendees. The panelists will be answering your questions throughout the presentation, and we'll stick around once the presentation is over to make sure any late questions are answered. We will be posting the webinar to our website once we get compliance approval, which is usually within a few days. With that, I'm going to talk for a few minutes about taxes and tariffs before we get into the markets. So, with the Liberals having won the election recently, it's worth checking in on the proposals they made during the campaign. The big one is that they are not moving forward with the increase to the capital gains inclusion rate, which was previously scheduled for January 1, 2026. Next on the list, they're looking at a 1% cut in the lowest tax bracket. The interesting part here is that the same tax rate also applies to most tax credits, which means that they may have to make additional changes to ensure that taxpayers don't lose out on those at the same time. Something similar is scheduled to go into effect in Alberta for 2025, with the lowest tax bracket seeing a 2% rate reduction, and they introduced a supplemental tax credit to address a similar issue. The Liberals also proposed reducing the minimum RIF withdrawals by 25% for 1 year. So for those looking for a little extra tax deferral, there may be an opportunity here. The remaining proposals aren't as impactful to most people. They may reduce new home GST, cancel the consumer carbon tax, and keep with the previously proposed increase to the capital gains exemption, which only applies to private shares and qualified farm property. But with that, I'll be moving from taxes to tariffs. There have been a lot of recent changes here, and I'll get to that. But first, I thought it'd be interesting to take a look at where Trump is coming from on this topic. It may seem a bit unusual to start with presidential social media posts. However, that seems to be how policy is being communicated in many cases. President Trump has repeatedly compared tariffs to income taxes when it comes to U.S. government receipts. You can see from the box on the right that he laments the move to income taxes in the first place. And on the left, he mentions that tariffs can be used to pay off the federal debt. What you're seeing in the graph is tariff revenue as a percentage of the total government receipts from 1798 through 2023. This bigger version of the graph here, back one, Kevin, if that's okay. Thanks. You can see that it starts in the 17 and 1800s, where a huge percentage of government receipts came from tariffs, whereas now it's quite small. The reason for this is that the US eventually abandoned regressive tariffs in favor of a more progressive tax system. Tariffs are considered regressive because people with lower incomes pay a larger share of their earnings towards the tariffs. The idea with a progressive tax system, similar to our system in Canada, is that as someone's income grows, the percentage of tax they pay grows as well, so that people with higher incomes pay a larger share of their earnings. You may notice a few significant drops in tariffs in the early years, and I'm guessing here a bit, but there was the War of 1812 in there. In 1834, all public debt was paid off, so Andrew Jackson cut tariffs in half, and that was reversed by John Tyler in 1842. There was a Civil War in there, 1861 to 1865, and then lastly, around 1913, income taxes were introduced, and from then on, you can see that tariffs are at their current low. Now, this chart provides a breakdown of the total federal tax revenue in the U.S. Back in 2023. It was $4.44 trillion. Now, import duties are roughly 2% of this, or $80 billion, whereas taxes linked to income provide roughly 85% of the revenue, or $3.8 trillion. With the value of goods being imported to the U.S. being about $3 trillion, just over, 70% tariff would be required to replace just the revenue from individual income taxes. And that's assuming the tariff doesn't alter purchasing behavior, which is unlikely. And I would hesitate to even attempt to calculate the tariff percentage you would need to address the federal debt, which currently sits just above 36 trillion. Next, if you want to demonstrate who pays tariffs, we can actually go back to Trump's first term. Back in 1819, there was a similar trade war between the US and China, and US farmers were subject to retaliatory tariffs on their exports. To offset this impact, 92% of the tariffs collected by the US from US importers were provided back as a subsidy to farmers. Trump authorized around $61 billion there. And this left the federal government with about 8% of the tariffs as a net addition to revenue. So at the end of the day, tariffs are like income taxes in that they're collected from US citizens and businesses, but they're regressive, and they also lead to retaliatory tariffs. And lastly, the effect is quite indirect. It seems much simpler in my mind just to charge a little extra tax than going through the pain of a trade war. Next slide. So to answer this question, yes, we did just sign a trade agreement. At the time, Trump spoke of how the USMCA replaced NAFTA, which he termed a nightmare, and he spoke quite highly of the USMCA, saying that it was the largest, most significant, modern, and balanced trade agreement in history, and that all of our countries would greatly benefit. Here you can see Mexican President Nieto and Trump sitting next to him. In the back, we see our ex-finance minister, Chrystia Freeland, and ex-PM Trudeau sitting in the front, back when they were getting along, I suppose. A reasonable question to ask when it comes to tariffs is how tariffs are allowed in the first place, given that we have a trade agreement. Well, if you want to understand this, you have to refer to Chapter 32, Exceptions and General Provisions of the USMCA, which is on the next slide. Here you can see that tariffs are allowed where national security interests are at play, which may explain why Donald Trump declared a national emergency at its borders. Now, I can see why this may apply to its southern border, where an emergency was declared on January 20th, 2025. But it's a bit tougher to see how it applies to Canada, where an emergency was declared on February 1st, 2025. Quick breakdown of drug seizures by the U.S. Customs and Border Protection. And here I'm using seizures as a proxy for drug inflow, which isn't perfect. But you can see that Mexico accounts for nearly all of the issue, with the U.S. making its own small contribution, and Canada doesn't even really register. When it comes to immigration, again, it's mostly Mexico. Here I'm using Border Patrol encounters as a proxy for illegal immigration, and Canada is contributing less than a tenth. This leads many to believe that the issue isn't really with drugs or illegal immigration, but rather with trade. Given Trump's focus on trade, it's instructive to take a look at the major trading partners of the US. This graph is ordered from left to right based on the orange part of the bar, which are those trading partners with the largest trade deficit on the left, to those with whom the US actually have the trade surplus on the right. The blue bars show the level of trade between the US and the other countries. And you can see Canada is the largest trading partner, followed closely by Mexico. But the key item to note is that despite being the largest trading partner, the US has a relatively small trade deficit with us. It's also worth noting that something like 80% of what we share back and forth with the US are intermediate goods. And also, almost half of Canada's exports to the United States are actually transactions between related parties. For example, branch plants or subsidiaries. And then this next graph shows that while they do have a trade deficit with us at around 40 billion going back to 23, you can see that over the last 25 years, this has actually varied quite a bit. And for a number of years, it was actually a surplus. So next slide. Despite all this, it appears Trump sees tariffs as a key tool he can leverage to get what he wants out of foreign countries, including Canada. It's worth noting that Trump has predicted that the U.S. aims to collect a significant amount of tariffs, and on an ongoing basis, at the same time, he has predicted that businesses would relocate to the U.S. to avoid tariffs. And so those two goals are in conflict. Moving on. When it comes to tariffs scheduled for Canada, we were able to get an initial deferral by agreeing to some stipulations, which I have on the next slide. And I suppose the great part about Canada being such a good trading partner, especially when it comes to drugs and illegal immigration and trade, is we are able to give Trump the outcomes he wants on some of these issues, since we're pretty much starting at the finish line. Nevertheless, we have agreed to some specific terms listed here. The border security plan was actually announced a while back, but we were able to make reference to it again in getting the initial tariff delay. We now have our first fentanyl czar and a joint strike force. All in all, these seem like fairly reasonable and limited steps given our part in contributing to the issues Trump has mentioned. And I should say that when it comes to money laundering, it turns out that Canada is a bit of a hub for this activity. So much so, in fact, that there is a term for it. It's called snow washing. So where are we now? Well, here's where we find ourselves. So the big news is that Carney and Trump are supposed to be meeting soon and can hopefully provide some certainty on what tariffs will look like going forward. I note here that the 90-day tariff pause doesn't really apply to Canada since we weren't part of the tariffs implemented in that round. And really, at this point, there are some tariffs, but mostly on goods that weren't covered under the current agreement, the USMCA. For what it's worth, Canada's taken several measures to fight back, a few of which I've listed here, just down at the bottom, and you can see that they're more or less even with the tariffs that the US is charging to Canada. And now I'll turn the presentation over to Kevin.
Sure. Thank you, Steve. Interesting, and you know what Steve went through is first thing I would have to say is that the speed of these tariff on, tariff off, tariff change that we've seen in the last let's call it month-ish is Steve's presentation is probably already irrelevant. Okay, so what I'll start with here is just want to do a quick 4-month recap, just to see what major indices we're doing around the world. You can see sort of for that first month and a half, things were running pretty smooth. We kind of got into, let's call it the mid-February, and the Trump camp started amping up their rhetoric a little bit on tariffs, what they potentially might look like. That led into the so-called famous Liberation Day, which was the beginning of April. I think they probably should have done it on April 1st as opposed to April 2nd, as it kind of seemed like a bit of an April Fool's joke. Watching, and I watch live here in my office, watching Trump with his, kind of handmade board with some what I'll call very interesting and strange math. Shortly thereafter, I mean, I don't think the American public felt liberated. I certainly know the stock market did not feel liberated. And post the stock market not feeling liberated, the bond market felt very non-liberated. And, you know, of course, he would never come out and say it, but the way the Treasury market was revolting, I think that probably turned up the heat a little bit. And we went from, advancing all this tariff talk to now kind of coming back and stepping back further on different tariffs and announcing different ones. And there was about a week or 10 days here where if you weren't tuned in for an hour or two and you plugged in post that, it felt like you missed quite a bit of what was going on in the market. Now you can see exactly where the low point was on the chart there, post the Liberation Day. In that phase, the NASDAQ was down almost 20, the S&P was down about 15% for the year. And of course, that followed by one of the largest day rallies in market history, where we sit at the end of the month with the Europe Australian Far East, the EFI index, up right around 10%. The TSX, our index, has been relatively flat. And the rest of the equity index is down, let's say, between 3 and 7%. And even as of today, the S&P 500 has been on a 9-day rally. The other 2 points I have on the chart here is February 3rd and the 24th. And the reason I have those in there is what I want to do is just a little recap of how we were managing the different portfolios on those different days. And, keep in mind what we were doing was just making a few little tweaks, prior to going into what we knew could become more of a volatile period. And just as a recap, managing risk is often a process of portfolio tweaks. You lighten up on risk, you add a little bit back. It's often the misconception is that people think that, we go into cash, out of cash, into cash, out of cash. Cash levels can definitely change. But I don't really ever see a scenario where we would be 100% cash, 100% equities, 100% cash, so on and so forth. So it's more of a matter of these minor tweaks around the fringes. And just looking at that, one of the largest rallies post that Liberation Day drop, it's simple to see what you may have missed managing your portfolios if you just missed that one day, which was roughly a 10% rally. And of course, that was just on one quick tweet, one quick tariff walkback. And that's something that no one could have predicted. And maybe not even President Trump predicted he was going to say that that day. So, take that for what it's worth. So investing and protecting, that's kind of the theme of what I want to talk about today is going through some of the trades, but then also putting a little bit of color around why we did them. So February 3rd, and I'll say, this varies based on portfolio. We manage right from a conservative model up to an aggressive growth model. So some of these trades happened in different portfolios. So on the trim sell side, QQQ, which is comprised mainly of the Magnificent Seven or the Mag Seven companies. They comprise a large part of this. So that's Alphabet, aka Google, Amazon, Apple, Microsoft, Meta, Facebook, Nvidia, and Tesla. They were getting a little bit frothy, and quite often, markets always hate uncertainty. And going into an uncertain time, sometimes it's a bit of this froth that, sees a little bit of the multiples come off. So, we were just being a little bit cautious and making a bit of a trim there. Um, Alibaba had a nice run from January, sitting around $85 into early February at around 100. So we made a trim of Alibaba. EQL, which is basically it's an equal weight S&P 500, and I'll get into that in a few moments as to what the difference is there. We lightened up exposure in that area in some portfolios. We have Dynamic Power Global Growth, which is more in our aggressive models, very high octane. So if you look at what the market is doing, this is generally doing a multiple one way or the other over the market. So has basically a higher volatility measure than the market does. So we took a trim on this position. We didn't completely eliminate it, but we did trim the position. We swapped Dynamic Global Discovery in favor of Dynamic Global Dividend. So not a huge change, just a change to recognize that, sometimes going from a slightly more growthy environment into more of an income and receiving dividend environment can work in a period that may be a little bit more choppy as well. And then on the flip side of that same day, and this is what I talked about, making these minor tweaks, is in some of the models, we bought Berkshire, which we can now buy Canadian hedged, and I'll get into that in a few moments as well. We bought some Dynamic Premium Yield, which has done a phenomenal job in the past of protecting in turbulent times. And we actually added to that position as most clients had held it prior to that. And like I mentioned, we switched Global Discovery for Global Dividend. February 24th, we actually sold the rest of our Alibaba, continued to run, reached a level of above 130. So we exited the entire position. And then we also sold another Chinese holding, which was Yumc as well. And on that same day, we actually flipped some of that money into I don't want to say like positions, but positions that were similar in theme, just a bit more diversified and less centric on just two stocks. So we added to Brandis Emerging Market Value, and we added a new position called KWEB, which is Crane Shares, CSI China Internet ETF as well. April 25th, trade we just made about a week ago. Very simple. We still like ExxonMobil. We became, I'll say, a little bit less bullish on the US dollar. And now remember, if you own US dollar securities and the US dollar is going up, you do very well. You do better than you would have just owning the stock. But if the US dollar goes the opposite direction, then the opposite of that happens. So if you were to say make 15% on a stock trade and the dollar moved against you by 10%, you only make roughly 5%. Our views on the US to Canadian dollar is we didn't think that the US dollar could really strengthen much more versus the Canadian dollar. And all in all, we think that the U.S. administration is going to try put a little bit of pressure on their dollar with some of the some of the things that they're currently doing is that works in their favor as well. So we basically just swapped that position for a hedged version. So recap on the sells. Again, you'll see there up until February 3rd when we made our first trade, things were pretty muted. We had Alibaba running a little bit. Most of the other positions we sold were not moving in lockstep, but moved relatively closely together. We're mainly up a little bit when we made that first trade. And then on February 24th, you can see quite a big divergence where Alibaba made that huge, less than 3 week run, which prompted us to sell the rest of the position. And then you can see the stuff that we sold kind of post that, and a lot of the stuff happening in March and April has slid off a little bit. And then the buy recap. And I'll get into a few of these in a moment as to why we did this. But you can see again up to February 3rd, not a huge divergence. Berkshire was doing maybe a little bit better, but in general, not massive moves. We can see Crane shares as well. There was doing better as well, just with a little bit better sentiment in China. And then post that, we can see up until Liberation Day, again, Crane share is doing quite well. Berkshire doing quite well. Even Brandis holding its own into there. And then that fairly, no matter what asset you held pretty much on that day or the next day, I should say, as well, is, there was a pretty good weak slide there. And then, a very nice recovery up until the end of April. Where we see Berkshire up, almost 17%, Crane share up about 10, and Brandis up 3, and then our premium yield position holding its own at about a -4, and then our swap to global dividend ended up being almost a neutral trade, didn't really help us, but nonetheless, we think going forward should be pretty good. So into some of the reason why we may have made some of these moves, the Magnificent Seven, which I chatted about, you can see there again, February 3rd, February 24th, and Liberation Day. This group, I'll say, had come under pressure prior to Liberation Day. And I think, there was a bit of a rotation starting kind of beginning of the year. So you can see by the time we had made our trade on February 3rd, and this is primarily the QQQ trade that we did on that day, is you can see that, Meta was still doing pretty good at that point, but everything else had kind of started to come off a little bit. And as we sit right now, I mean, we can see Tesla, still down in the 30s. At one point, before its recent rally of about a week ago, it was down almost 50% year to date. With, I'm sure everyone's seeing all the different Tesla activity after Elon Musk's involvement in Mega, over the last little while as well has affected that share price. And investors seem to have rejoiced a little bit that he's kind of going back to work at Tesla and has a little bit less involvement in politics. Not a ton to say here, but just to say, when we're managing money, we always have to be aware, when we're owning indices as to what exactly is happening within those indices. So I just wanted to highlight, and this was the end of 2024. In those two red circles, you can see the NASDAQ 100. Those 7 stocks that I talked about, the Mag 7, actually became almost half of the NASDAQ 100 index, so 45%. And they became roughly a third of the S&P 500. So in order to invest in those two indices, of which QQQ and NASDAQ 100 are roughly the same, if you own just a regular S&P 500, you just have to be aware of where the concentrated risk is there. And you have to be able to express an opinion on that, which we did early February by basically trimming that QQQ position in some portfolios and selling it outright in other portfolios. Just another quick chart. It just shows again end of 2024. That Magnificent Seven as a basket was valued at a 30x multiple of forward earnings, whereas we look on the S&P 500 was about a 20x, and that's that difference between the 493 stocks sit below those seven at about an 18x versus, including that Magnificent Seven basket in there. Again, we felt that, valuation eventually matters. And often in times of uncertainty, like I said, the more richly valued assets can have a little bit of a cut. Again, just showing that 2025, 2026, the earnings of the Magnificent Seven, as a proportion of the other 493 stocks was also expected to narrow. So again, expressing a view of trimming that, and where we do own the S&P 500, besides some exposure in some of the mutual funds, we hold it as an equal weight basket, where essentially the 500 stocks are held equally, throughout the strategy. Berkshire. So, the Berkshire trade we did early February. I'm going to call this a really simple trade. In times of market uncertainty, I mean, as the four group here of managers managing, the assets, we've all seen this happen in our career. When things go, I don't want to say go wrong, but I'll say when times become uncertain in the market, Warren is one of those geniuses that figures out a way to make deals, and to get exposure generally to the right companies. So again, we were just expecting him to potentially work his magic, and I'll say even a little bit more excited by what he had done in the last year. You can see there he had gone from what I'll say is a relatively light cash position on the left, to by the end of the year, he was sitting on about 325 billion of cash. And I'll show you a few more charts on that. But he was cashing up for an event. So when I talked before about in cash, out of cash, this maybe could be considered one of our cash holdings, just holding some Berkshire. There's just his cash position again towards the end of 2024 of over 300 billion, and as a percentage of his actual holdings, let's call it 30 to a third of the entire holdings. And there's just a quick, interesting look at him from the beginning of the year to the day we made the trade to where he's ended up as of the end of April, being up almost 17%, versus the S&P down over 5% and the NASDAQ down around 7%. So one of the other assets I said we added to was dynamic premium yield. I won't get into the mechanics of what's going on in this particular investment. It is an option-based strategy, but it's an option-based strategy designed to protect. And with these strategies, the proof's always in the pudding. So we can look back and see, 2018, 2020, 2022, when things aren't going that well, or there's a little bit more uncertainty in the market. What we found with this investment is if you look at the drawdown of the S&P 500, the drawdown on negative days or the down capture has been 1/3 of what the S&P 500 has. So a very good protective investment to be in. But I'll say protective for a reason. The way this is designed to have a higher income than most investment strategies, and that's again with some of the optionality. So just a quick, this is as of a month or two ago. They had a gross internal yield of about 10.4 and a gross internal yield with hedges. And what the hedges really mean is they're hedging downside risk in here. So this strategy pays out right around that 7%, a little above 7%, into the portfolio, which is also tax preferred, which is nice when we have this in corporate accounts and non-reg accounts. And you'll see the beta there of 0.41. What that means is that this moves about 0.41 with the S&P 500 on average. So again, a little bit of a muted volatility, and works extremely well in times of uncertainty. Last little piece I'll talk about here is alternatives. We've talked about it a lot in the past. We've had discussions just around this topic. And again, it's just to open the horizon is when we're investing in today's world, we're not just in the world of where we were 20, 30 years ago with thinking we can own cash, equities, or fixed income bonds. There's this new suite here of alternative investments. They've been around a long time. They just used to be for the ultra wealthy. And then, we've found ways to figure out how to add them into a portfolio and make them very effective at reducing risk and doing pretty well in these uncertain times as well. So alts, I mean, this chart shows real estate, gold, silver, crypto. We don't invest in crypto. I'm not even going to go there today. I have a lot of views on it, but it's not something that I would say you're ever going to see in our alt basket. Instead, when we look at alts, we're looking at private equity. The public stock market dwarfs the amount of non-public companies, and even the trends in the last decades. There was more public companies a few decades ago than there is now, or even a decade ago, as some have become private. And sometimes a private business can operate a little bit differently than a public equity. We have private debt, same reason. Those are off-bank loans. There can be hedge funds, and I mean, hedge funds can be, they can be merger arbitrage, or it can be SPACs, or it can be long short. There's a ton of different things that could be encompassed in hedge funds. There can be private real estate. There can be commodities, which can include gold, grains, different futures. Collectibles is kind of neat. I mean, if you look at the sports collectibles and just even some very unique collectibles, those have done very well. Whiskey, wine, art. We of course don't invest in that, but that's kind of an outside of a portfolio thing. And then structured products, which we've started to talk about a little bit here, where essentially we can set a floor on assets and do different things to structure a little bit of a different outcome. And I will now pass it on to Mike to delve into market expectations a little bit.
Thanks, Kevin. So with the ever-changing landscape that we're going through right now, I'm amazed that when something I wrote even a week ago still holds some merit. And one of the potential themes that could be emerging right now, I'm pleasantly surprised to see that it seems to still hold some weight. And that theme is this, that going forward, we were likely to see less of a reliance on the United States, the US market, and US assets. So how do we come to that? That's almost a complete 180-degree turn from the graph that you're currently seeing on your screen. So what you're seeing right there is the price to earnings ratio for the major markets, the US, Europe, and China. And just as a refresher, the price to earnings ratio, put simply, is the dollar amount that you would need to pay for $1 of a company's earnings. So a stock with a PE ratio of 20, you would have to pay $20 for that $1 of earnings. So looking at this graph, it would not support our statement that going forward that there's going to be less reliance potentially on the United States. So how did we get here? Well, going into the end of the year, investors were bullish and euphoric on the US stock market. Based on the Trump platform, they were looking forward to tax cuts, sweeping deregulation, and fiscal expansion. As a result, stock prices soared, bond yields rose, and the US dollar rallied. Now, for the rest of the world, things didn't look quite so rosy. In Europe, for years, the Eurozone economy in general, and Germany in particular, has been plagued by excess domestic savings, forcing the economy to rely on net exports or foreign demand for economic growth. Doom and gloom have been the dominant emotions as the Russian-Ukraine war has dragged on for years, and the German economy, the engine of growth for the Eurozone, has fallen into protracted stagnation. In China, the government in 2021 began to crack down on the private sector, which dramatically changed the environment for private businesses. When they emerged from the COVID lockdowns, we didn't see the wave of spending and consumption that we saw in the West. Instead, the Chinese consumer sentiment dropped in China and people began to hoard cash. For Canada, what we had to look forward to was the potential for another trade showdown with the US, as Steve mentioned, with the successor to NAFTA, the United States-Mexico-Canada agreement, insisted on by the first Trump administration, apparently wasn't good enough. And if that wasn't enough, after 10 years of the Trudeau Liberals and their policy agenda, the Canadian economy has languished, productivity has dropped, and prior to COVID, the problem we had with inflation was that we arguably didn't have enough of it. As a result, equity valuations in the US were far higher than the rest of the world markets. So fast forward to 2025 and Trump 2.0. As Trump took office, talk of tax cuts and deregulation was replaced by increasingly confrontational rhetoric regarding the trade imbalances with America's allies. And there was a distinctively authoritarian approach emerging to push the MAGA agenda. Since the tariff war has erupted, US investors have now realized that they'll be dealing with tax hikes, because that's essentially what a tariff or a reciprocal tariff on goods is. It's an increased cost to the consumer, fiscal constraint, and increased policy uncertainty. Investors are beginning to fear the potential for a recession and or stagflation, meaning high inflation in a sluggish economy. So what the graph here is showing is that the top part of the graph is that the number of investors with a bullish outlook in the United States equity markets has dropped substantially, and the majority were turning bearish, meaning that they felt that the US market was going to drop and not continue to expand. The graph on the bottom represents trade uncertainty, and that has gone through the roof since the start of the Trump term. So overall, the trajectory in the US markets in general have been declining. While Trump has been a divisive influence with the US, he's been a marvelous unifier everywhere else. His hardball approach to America's allies in China in particular has been a powerful catalyst for a sea change in public policies in Eurasia. This has pushed China to inject more stimulus into its domestic consumption, and it's forced Europe to regroup, reform, and rearm via dramatic fiscal expansion. So leading into the US election, the Political Bureau of the Chinese Party of China Central Committee held a meeting to analyze and discuss the current economic situation and make plans for the future. This marked the first time that this meeting was held in September. And for a lot of China watchers, this signaled that the Chinese leadership was committed to stabilizing growth and managing expectations. And we can also add in there, even though it was only September, starting to prepare for a future second round of a Trump administration. The Chinese government has been fully aware of its economic problem, lack of domestic consumption, but has been reluctant to up its fiscal game amid fears of racking up too much debt. Trump's tariff war and the persistent price deflation in China have finally pushed Beijing into moving into two major moves. The first, they're sharply increasing their deficit spending to shore up growth. And secondly, they're promoting private sector growth by providing legal, financial, and institutional support to entrepreneurs. This is a major reversal from the crackdown that started in 2021. In Europe, while most of the rest of the Eurozone has already run large fiscal deficits with negative or no current account surpluses, it's Germany that matters. The German parliament passed about a month ago a historical package of constitutional reforms, allowing them to go deeper into debt. This allowed the incoming Merz government, to sharply upscale both defense spending and launch a 500 billion euro funding package to boost Germany's infrastructure investment. This combined military and infrastructure package will be about 1 trillion euro over the next 12 years. So think about that. In 2022, when Russia invaded Ukraine, it wasn't enough to get Berlin off the sidelines. Now, the distance between Berlin and Kiev is only about 1,200 kilometers. So think a little bit further than the distance between Edmonton and Vancouver. The rhetoric coming out of the Trump White House was essentially the straw that broke the camel's back for the Germans. So this reform represents a U-turn in Germany's self-imposed fiscal austerity and will likely boost GDP growth by more than 1 to 2% per year. In Canada, because we've been in the throes of a leadership change in the Liberal Party and a run-up to the election last week, there hasn't been a lot of policy movement here at home other than the expected retaliatory tariffs on US goods. Because of this, the provincial governments and the Canadian consumer have taken it upon themselves to promote more brand awareness for Canadian products and to steer away from US goods. So going forward, what this kind of means is potentially we're seeing a divergence between the US markets and the rest of the world. We can expect more policy uncertainty from the United States. Even though the Trump administration appears to be the ones to have flinched first in this tariff war, as timelines and some of the tariffs have been delayed or amended, more and more exemptions are being discussed, and the US appears to have bitten off more than it can chew with its approach to China. American exceptionalism has given way to a sell-off in US assets as the world comes to terms with the lack of trust in the United States. So what we're seeing in this graph is very similar to the one that Kevin just showed up, showing the overall market returns from the start of the year up to May the 1st. So the green line is the Eurozone. The pink line would be China. Blue is Canada, and in red is the S&P 500 or the broader US stock market. So ironically, all the areas that the US have targeted throughout this trade battle have enjoyed positive returns so far this year, and it's the US itself that is in a slump. Now, while it's too soon to tell what kind of impacts the tariffs and US policy will be on the rest of the world, the one thing that just about everyone else has going for them is a degree of certainty that they cannot continue to rely on the US for any goodwill or support. Canada, like the rest of the world, is realizing that relying solely on the US will leave them particularly susceptible to US exceptionalism. Hence the rhetoric of us becoming the 51st state. So there's an old saying in investing, which is if the US economy sneezes, the rest of the world catches a cold. So for the first time in a long while, the fiscal stance between the US and the rest of the world is diverging, especially if the United States continues on the path that it's on. The former United States is setting up for fiscal austerity, while the rest of the world is looking forward to potentially fiscal expansion. And with that, I'll pass along to Jay.
All right, thanks, Mike. So from everything we've heard today from Steve, Kevin, and Mike, is we can sum that all up in one word: uncertainty. And markets never like that word, and that can lead to volatility, which we have seen this year. I'm just here for a couple minutes just to talk about, as clients and listeners on the other side here, what we can do in times like this. So for all of you that are listening, this should be a reminder from our meetings, but I'm just going to go over a few points that you can think about during times like this. I think number one is the keyest point is stay invested. And if we're looking at the first slide here, this graph shows the 10 worst trading days in the market in red since 2008. And it also has the 10 best trading days in green. And I think the main things to take out of this are the volatility tends to happen in clusters, and they're usually close together. So when markets tumble, it can be tempting to cut and run, but getting out of the wrong time can lead to losses. And worse, it can mean watching from the sidelines or the shore when the markets are recovering. The second slide, Kev, if you can just go to that one. This just shows you the importance also of staying invested. And it basically shows you if you had an initial investment of $100,000 in the S&P 500 for the last 30 years. It also shows you what that investment would have done if you had missed some key days during that. So staying invested, that investment would have netted you around 2.1 million over that period. If you missed the one best day over that period, you would have seen a $160,000 loss or difference. The 10 best days, obviously a significant downside, leading all the way down. If you missed the 100 best days during that period, you would have actually have had a negative investment over that period. I'll kind of further this with, this point with a stat from Miles Zablock, the chief investment strategist from Dynamic Funds. He basically said that if you show that the calendar year returns are heavily dependent on market action and over a very small number of trading days. So the average calendar year return of the S&P 500 over the last 25 years has been around 9.4%. Calculated after missing the 10 best trading days of each year, if you just took out those 10 best days of each year, that drops almost to an unbelievable negative 14.1%. That's a pretty insane stat. So just missing the 10 best days of each year can take that 25-year return to a negative instead of a positive average. So the second thing I think is diversify. It's the old adage about not putting all your eggs in one basket. And a diversified portfolio includes investments in many different countries, asset classes, stocks, bonds, cash, alternatives, which Kevin talked about earlier, and sectors such as energy, financials, technology. This allows you to benefit from the investments that are doing well while softening the blow when others are dipping, which is the reason, for discretionary portfolios, that's what we're working on in the background as indicated earlier. The third thing is take a long-term perspective. We define long-term as 5 years or more, and which is an eternity today in today's 24-hour news cycle. So if you can tune them out, and stick with your plan, you'll have a better chance of reaching your investment goals. Fourth is make volatility work for you. Most people would agree that falling markets are the best time to invest. We get it. Intellectually, we know that these are bargains to be found, but personally, investing isn't purely an intellectual exercise. And when it comes to your actual savings, fewer have the nerve to dive in during down markets. Why is that? Part of the anxiety may come down to timing. We can't help but wonder, is this really the right time to buy? One way to get around that, and a lot of our clients do this, is dollar cost averaging. And dollar cost averaging can reduce this anxiety. It can, it's that set it and forget it strategy, which you can commit to a fixed amount of money each month or on a regular schedule when you get pay periods. When markets rise, you buy fewer units. When markets fall, you buy more. And over time, your purchase price typically averages out. This type of plan doesn't guarantee a profit, but it'll also help take out the emotions out of the investing and keep your plan on track. I think even in times like this, if you've got that extra money sitting on the sidelines, that's a decent way to start to enter it into the markets, is averaging it in over a period of time. And the last thing is talk to your advisor. I've said this to clients is, when you're sick, you go to see a doctor. If you have engine troubles, you go to see a mechanic. Well, if you have concerns about the impact of market volatility, maybe having on your portfolio, come talk to us. I think that's the main thing that we're trying to get out, is a little bit of education on that for our clients here. So I think that'll wrap up the webinar for us today. Kevin, I'll just kind of maybe see if there's any questions that have been left unanswered. I don't see any in the queue.
Jay, there are no questions I see on the board.
So as always, guys, the webinar will be filmed. It'll be on the website as well if you wanted to rewatch any of the content that was shown. But we want to thank everyone for joining us today. We hope you guys enjoy the nice weather that's upcoming this weekend. And if you have any questions, please don't hesitate to reach out to us.